What's going on? We're going to be talking about the future of Dillard's and what's next for the company. So I'm looking for a dividend stock to add to my portfolio, and maybe Dillard will be one of them. So is Dillard on the verge of a comeback or facing an uncertain future? With the retail landscape in a constant flux, we are diving into strategy and challenge Dillard's face as a if it navigates the changes of consumer landscape. So if you don't know who Dillard is or what Dillard is, here's a video of what Dillard is. So highlight Dillard's. So customers very loyal to Dillard's. They have credit cards, they offer perks. So there is some brand loyalty there. Now, Dillard's success has been rooted to the commitment to traditional retail values. So Dillard's is a legacy. They give quality service and they've been around for a while. Now with the shifting retail landscape, it's the big thing that I'm going to be analyzing on this stock, looking at Dillard's strategies for growth, emerging trends and opportunities, and the future of Dillard's. And those are some things I'm going to look at. But before I do all that, I am looking for a dividend stock that to add to my portfolio. Maybe it'll be Dillard, maybe not, but it has to meet these criteria. One, is it a dividend paying stock? Two, is this stock going to be in a good financial standing? And three, will there be growth opportunity with the company? So let's get into this video and look at the stock. So let's look at this Dillard stock and see what is worth it. Now, if you want to know what Dillard is a retail store. Here's the website. So this is Dillard's website, and they sell brands, they sell colognes, they're pretty much a consumer company, and they sell products. Now, the thing about them, are they going to be around for a while? And what's the future for Dillard? What is their strategy that they're going to be doing? Now, they do have a lot of brands. Now, the issue I have with them is these retail giants over with. But before I do all that, let's look into the stocks. This is what Dillard is, and they used to be in almost every single mall, and people go there and buy a bunch of stuff. But malls are kind of dying, and online presence is a better place for these purchases. Now, this is Dillard's and stock, and let's see how they've been doing over the last month. So last month they grew 12.56. 3 months they grew 1.78. Year to date they're negative 8.27. A year is negative 6.31. And 3 years is 29.20. And 5 years it is up 1,296%. Now, looking at these charts, it still looks like it's on its upward trend. But that's not the truth of the matter. We have to look at the finance and see how they're doing financially, because the stock's supposed to grow with the company. When the company makes more money, the stock's supposed to go up. That's how normally stock's supposed to work. It doesn't always work like that, but this is why I tell you, you need to look at the finance and understand what you're investing in, if they're making money. So before everything, I want to look at the gross margin. Do they have a good margin for profit? Because sometimes if they're not in a good margin, it's not going to do so well. And if you don't know what gross margin is, here's the definition. It's a percent of revenue minus the cost of goods sold. So it is 40.53%. And then their net profit is 9.01%. Now, if you don't know what these definitions are, if you click on this or put it over the side, you'll see what the definition of each one so you can understand. So net profit shows how much of each dollar in revenue translate into profit. And this is what I'm concerned about. It's the 9.01 and 10.75. It's not a bad profit margin. That means they're making money and they're not negative, which is a good thing. The operational Operating income. So it says the gross profit minus the operation expenses, and operation expenses include mostly sell, market, general, and everything else like that. So that's how it is. But this is what I look at to see if it's really worth investing in a stock for future growth. So 6.4, 6.42 billion, 6.5, 6.34, 4.3 or 43 billion. And I'm just looking at this number, see if it's going up or if it's stagnating. To me, this stock has leveled out. So I don't see a future growth in this stock unless they do something dramatic. And that's why you have to understand what's the future plan. But I also like to go into their balance sheet. How much money do this company have and what asset they have? So the current asset is 2.37 billion from 2.21 billion. So it looks like their current asset is increasing. So that means they could either expect more to sell, more inventory. It could be anything like that. So fixed assets, more like assets that they can't really sell long term. And it looks like they're dropping their fixed assets, which could be buildings or facilities, things of that sort of nature. So current liability. What I like to do is take the long term and current liability, add them up, and see if the current asset is more or less. Because if they have more current assets and fixed assets than they do have debt, and it's something I will look into buying. I do not like a company that owes more in liability and long-term debt and owes more on the current than the current asset. So if we look at this, we'll see that if you add these together, it's about $3.4 billion. And it looks like they have 1.2, 1.3 billion in debt. So, but this is another thing you need to look at. See if their current liability is going up. So 834 million in current liability. So it looks like they've been stagnated there, which is a good thing. Now, are they able to pay their long-term debts? Let's see if they've been decreasing it. It looks like they have been decreasing their long-term debt, which is a good thing. So that doesn't tell you everything about the finance of a company, and this is where you need to go to the next step. It's looking at the cash flow. So the cash flow is very important to look at. So operating cash flow, this is how much cash the company generates. So it's $714 million. How is it compared to the previous year? 883 million, 948 million, 1.2 billion, 252. From 2021 to 2025, it did see a growth. But from 2022, it's having a dramatic decrease of operation cash flow. That's not a good thing. I don't like that. And then invested cash. So investment cash is generated or spending related to investment activity. So they've been investing a lot of money, and it looks like they've been increasing that. Financing cash flow is raising capital such as share or bonds that the company issues for loans to take out. So it looks like they've been, since 2022, they've been decreasing it, which is not bad. And here's the other thing I like to look at is the ending cash position. How much cash are they ending it? Are they have more than the previous year, or if they have less? It's pretty important because it shows you if they're spending more than they are making from the previous year. And it looks like they have, because they have, and the ending cash flow of 2024 is $808 million. And the ending cash flow of 2025 is 717. So it shows that they are decreasing in that. So it's not that good. So based off the financing, I don't see the growth opportunity. Financially, they're stable, but they slowly looks like they're dwindling according to that. Now, you can look at key ratios and compare it to the other companies and what they have, but I just kind of looked over it. Now, Operation margin, they have a 13.7, but after looking at the expenses, no point of me going to detail right here because financially they don't look like they're going to be growing based off what I found. I do like to see what investors are involved with the company to see if they're worth investing, see who's leaving it and who's is buying the company. Let's see who's leaving. Newport. All right, I don't really know any of these people. I know Citadel, Bank of America. So they look like they are purchasing them, which is interesting. But I don't see like BlackRock or State Street, so it makes me wonder. Now let's look into the company, see if anyone's selling it. Looks like no one's really selling their stock; they're keeping it, which is a good thing. So to me, this stock financially is stable, but it doesn't meet the growth opportunity. So let's look at the dividend and let's check the history of it. So they've been growing their dividend for the last 10 years, which is a good thing. And they have a dividend growth of 23.81. And if you look at the history, you can see that the history, they've been paying it consistently. So that's a good thing. So it is a good, stable stock. Now, if you want to look at stats, you can come here and look at the stats too, the ratio. I do like to compare to see if both websites are accurate, which one could be off, because sometimes the numbers are off on another website. So I kind of like to skim over it. And to me, everything looks like the same. Valuation ratio, 10.9, forward PE, 14.47. So looking at these numbers, it looks like it's the exact same thing. And let's go into what AI thinks of this. Because based off the information I got, if I look at the chart and look at the 3-year, 5-year term, it's supposed to be growing. But I can't always rely on what the stocks has been doing of the history of the stock. And this is why you have to go looking at the finance of the company. If the finance isn't a good, stable company, it's not a good thing. Now, this company is stable. They have a lot of money, but based off the information of how the growth of the cash flow and everything, it's just not going to be growing as I want. But we can look at AI and see what they say. So AI say growth is 1 out of 6. Based off what the information I saw on the financial sheet, I agree with it. Performance 2 out of 6, health 1 out of 6, valuation 3 out of 6, and earning 2 out of 6. I kind of agree with this. If you're comparing to Amazon or something like that, the earnings is going to be a lot lower and the valuation is about average. And we can compare it to the competitors, and Dillard's is below peer average. So that an industry average is way below. So I don't recommend it because it's below average. And earning on here, of course, the PE ratio is $593 million. Now, price to sell PS ratio is below industry average, but it's above its peer. I just don't like things below it. And what analyst says is to sell this company because they predict it to drop more. Do I agree with them? Yes. I 100% agree with the analyst on this one and based off everything I see. And then if I look at the financial health of it and the ratio, yeah, it just does not look like it's going to do well. The debt to equality ratio, it has been dropping, which is a good thing. People like Target or companies like Target, Macy's, Kohl's, and Best Buy has increased their debt to income ratio, where Dillard's is the only one that looks like it's decreasing. So based off all that information about Dillard's, I won't be investing into them. It's just that I don't see the growth. It looks like they're going to be continuing with the price they have or even decreasing because of how the market is going. Retail market isn't a good place to be in right now. I don't see them doing anything special. And I don't think they have any special plans to increase their sales. That's all I got for you. Like and subscribe to my video and comment down below.